My name is David Hickson, and today is the 8th of February 2016. Before we take a look at the markets and speak about the markets, we need to, as always, please make sure that you have read and understood these disclaimers. They are very important. We are speaking about trading, but I'm not making any representation. And I'm not giving any financial advice because I'm not qualified to do that. I am, however, qualified to speak about Hurst cycles and how they work in the market. So let's start taking a look at that. If you have any questions, please pop them into the chat window. I'll be delighted to answer as many questions as I can. What I would like to speak about today is a very interesting pattern that forms in financial markets because of the combination of the cycles which influence price. And that pattern is called a mid-channel pause, and it's something that's often overlooked or even perhaps misunderstood. Quite a lot of people that have mentioned the mid-channel pause to me have mentioned that they didn't really understand what it was about, and it all seemed a bit complicated. In fact, it's not complicated at all, and I'm going to just spend a few minutes explaining what the mid-channel pause is, and then we're going to take a look at a recent example of the mid-channel pause, and then I would like to tie up today's webinar. I'm hoping it's going to be a fairly quick webinar today. I'm going to tie up today's webinar by taking a look at a very long-term chart of the S&P 500, an analysis of the US markets, and I'm going to point out a really important mid-channel pause, in my opinion, and we can discuss that, and we can see whether you agree that it is indeed a mid-channel pause, because if it is, then it has some very important implications for what we can expect to happen. So you're looking at a chart at the moment that you're probably fairly familiar with. If you've seen any of the videos I've recorded about Hurst cycles, any of the introductory videos, then you will know that this is a way of representing the way in which cycles influence financial markets. And this is very simply the result of an Excel spreadsheet. We're looking at it in Excel. And what I've done in the Excel spreadsheet is I have created a series of cycles. And those cycles are, in fact, very simply sine waves. Now, the sine wave is one way of representing the cycle that influences, or the cycles that influence financial markets. We could have a big debate about whether the sine wave is actually an appropriate representation. There are some people I know who don't think the sine wave is a very realistic representation, but that's a detail we don't need to worry too much about at the moment. But at the foot of this chart, you will see three lines. There's this orange line over here, and there is this blue line over here. Oops, and there is this red line over here. Now, those three lines are simply the graphic representation of these three sine curves that I have created in Excel, and each one of those lines represents a cycle. So I've color coded them, so we have the orange cycle, then the blue cycle, then the red cycle. Just a few points worth noting about the cycles. Each cycle, of course, goes up and then comes down, then up, then up, then down, and so on. That, by definition, is what a cycle is. It is something that moves up or causes price to move up, perhaps we could say. So it has an upward influence for a while, then it has a downward influence for a while. And the influence together form a complete cycle. So you go up and then down, and that forms a complete cycle. Then you go up and you go down again, and that's the next cycle. The wavelength of the cycle is measured as the distance between the troughs. It is also measured as the distance between the peaks, because of course that distance is the same. So in fact, the sort of technically correct way of stating the wavelength is the distance between any two equally phased points. There could be peaks, there could be troughs, there could be halfway up or halfway down, but that is the wavelength of the cycle. And you can see with 3 cycles that we have at the foot of this chart, the shortest cycle is, of course, the orange cycle. And the next longer wavelength cycle is this blue cycle. You'll notice that the orange and blue cycles and also the red cycle obey some of Hurst's, have the principle of harmonicity, which tells us that the harmonic ratio between the wavelengths of those cycles is a small integer value, such as 2 to 1 or 3 to 1. And you can see that the wavelength of the blue cycle, measuring from trough to trough of the blue cycle, is exactly double or 2 times the wavelength of the orange cycle. So we fit 2 orange cycle waves into one of the blue cycles, and therefore they obey the principle of harmonicity, which is that their wavelengths have a harmonic ratio, which is either 2 or 3, a small integer value. And the red cycle has a wavelength which is the entire width of the chart. That's the wavelength of the red cycle. And it also has a harmonic ratio with the blue cycle of 2 to 1. We fit 2 blue cycles into each red cycle. Okay, none of this is new. I'm sure you're all really very familiar with it. The other important point worth mentioning is that the amplitude, or the strength, also increases as the cycle's wavelength gets longer. You can measure the amplitude by the amount that the cycle pushes up. That distance there on the y-axis is the amplitude of the orange cycle. And this amplitude here, that distance on the y-axis, is the amplitude of the red cycle. Hello, Alain. Alain, I know, does a lot of work with cycles in Excel, so you can probably give us a more detailed discussion of this whole process. But the important point to mention here with regard to the wavelengths is that Hurst defined the principle of proportionality, which tells us that the various aspects of the cycles are proportional to one another, and therefore the amplitude of the cycles should be proportional to its wavelength. So when we get a cycle that is double the wavelength of another cycle, then its amplitude should be double according to the principle of proportionality. Now, I found the principle of proportionality is the least reliable of the principles. And I've also found that, in fact, cycle shapes in the markets, if you don't assume, and so instead of doubling the wavelength, and instead of doubling the amplitude when you double the wavelength, I multiply it by about 1.5. And excuse me, I think you can see on this chart that that is what's happening with the amplitude here. Here's the amplitude of the orange cycle, and the blue cycle is only about 1.5 or maybe 1 1/3 times the amplitude of the orange cycle, and the red cycle is about 1.5, perhaps 1 1/3 times the amplitude of the blue cycle. Okay, so the principle of proportionality isn't entirely accurate in this chart, but I believe more accurate in relation to what we see happening in the markets. Okay, and see, Alan says proportionality goes more or less from up to down like the Russian dolls. Yes, so you get your cycles all fitting into one another, but the amplitude tends not to be proportional to the wavelength. I've found in my experience. Hello, David. I'm seeing hello, Stan. I'm seeing people coming in. Great. So I'm sure you're all very familiar with this chart, and this is a chart that I use very often to demonstrate how the theory of Hurst's cycles works, is that you take a whole lot of cycles and you combine them. I see Miguel's Fibo ratio. In fact, that's a very interesting point, Miguel, because I think I often do use a Fibo ratio. I make this 5. I'm not really managing to write very clearly with this pen. I make that 5 perhaps, and this 8. So it is a fib ratio, but that's just a personal preference. I like to use fib ratios generally. I haven't ever really sort of tested to see whether fib ratios do tend to be the proportionality between the wavelength and the amplitude, but it's a very interesting point, very interesting thing to look at and think about. So I'm sure you're familiar with this kind of graph where we have the 3 cycles at the foot of the chart. Then the green line, I haven't spoken about yet, but it's this line up at the top, is very simply the combination of those 3 cycle lines, and they obey the principle of summation, which is one of the principles that Hurst defined, which is that basically you simply add up the influence of all of the cycles and you end up with that green line or the price line. Of course, then if it is price in the real markets, then you need to add in a little bit of noise, a bit of randomness, and a little bit of fundamental interaction and all that kind of thing, and you end up with the price. But the idea is that you simply add up the amplitude of all of these cycles. Okay. I see William says occasionally the shorter wave will have a greater amplitude than the longer wave. Absolutely. And the principle of proportionality, in other words, the ratio between the amplitude and the wavelength, is, in my experience, the principle that needs to be given the most room to breathe. And amplitude can vary tremendously. Sometimes you get a short cycle that has very strong amplitude. It's a really powerful cycle. And then sometimes you will have a long cycle that has very low amplitude. So that's probably a discussion for another webinar. The speed with which amplitude changes is a very interesting subject for discussion as well. How quickly will the amplitude of one cycle change? You know, could a cycle be very strong over one wave, and then in the next wave all but disappear because its amplitude has been reduced? That sort of discussion perhaps we should in a later webinar. But the point about this chart, this graph that I'm showing you, is that this green line over here that I will draw over is the result of combining these 3 cycles. Now there is a particular reason that I've chosen 3, which is that when you combine 3 cycles, you generally get a shape which is a shape that you often see in the markets. You know, of course, that I often speak about the M shape that cycles make, and I wonder if I can find another chart that'll demonstrate this. Let's see what. No, I'm not able to switch between charts at the moment. But the M shape you can see here, that is the result of combining 2 cycles. If we sort of simplify this graphic a little bit, that's the M shape that cycles make, and you see M shapes repeating again and again. When you add a 3rd cycle, you get this green line here, which is of course still an M shape, but it has a little more detail. And the little more detail that it has are these wobbles on the way up and the way down. Okay, that wobble there and that wobble there. Now, wobble isn't the technical term for those moves. The technical term is a mid-channel pause. And spoke about the mid-channel pause. I must admit, I found his description of the mid-channel pause in the Hurst Cycles course slightly confusing. I had to read the few pages about the mid-channel pause a few times before I worked out what exactly it was and how it worked. But effectively, this wobble on the way up for the M shape and this wobble on the way down are the mid-channel pause. Now, why does the mid-channel pause form? Why are we seeing that wobble on the way up and again on the way down? It's because of the combination of the cycles, and in particular, it's because of the combination of this blue cycle and this orange cycle. You'll notice that at this particular point, where I've drawn the arrows, the blue cycle is at a peak, and the orange cycle is at a trough. And as they move into that point, the blue cycle is moving up and the orange cycle is moving down. So those 2 cycles are moving counter to each other. They're moving in contrary directions. And as we pass this vertical line that I've drawn and move further to the right of the graph, you will see that they continue to move in contrary directions, with the blue cycle moving down and the orange cycle moving up. But the result of the fact that they're moving in different directions and the blue cycle is forming a peak at exactly the same time that the orange cycle is forming a trough, sort of compresses the two cycles, and they cancel one another out, if you like. And the result is that you get this thing here, which is called channel pause. I often call it just a wobble because that's what it is. It's just a kind of a hesitation in price on the way up. So price is moving from this big trough over here, and perhaps I should point out that, of course, this left-hand edge of the chart is the trough, the red cycle, and here's the next trough of the red cycle over here. We can draw our diamonds over there, and third one underneath there. And so price is moving from the trough of the red cycle up to the first peak of the M shape. And of course, it comes down to the intermediate trough, comes up to the second peak over there, and then comes down again. But on the way up, it encounters this mid-channel pause. And it doesn't look very impressive. It's not really very impressive, but it's a very, very important thing to be aware of, because you can trade it very profitably. I found in my experience, and I'm going to explain to you how to trade it in today's webinar. I see a comment from Alain. First of all, yes, in the graph, the underlying trend is flat or neutral, absolutely. If I haven't added any other cycles, if I added other cycles, then of course we'd get a distortion to the upside or to the downside, and so this whole drawing would be sort of twisted. You know, if we added an even longer cycle, then we would get we'd get something like that for the M shape, but for the purpose of understanding the theory behind the mid-channel pause, I'm looking at something with an underlying trend which is neutral. And Alain says, is it a mid-trend pause rather than a mid-channel pause? Which is mid-channel? Is the centered moving average in which the channel is based? Okay, so that's that's a very good question, and it is one of the things that bothered me, Alain, when I was reading the cycles course. Is why is it called the mid-channel? Is it definitely in the middle of the channel? And I don't work very much with channels, as you're probably aware, but Hurst channels are based upon a displaced moving average. So let me try and draw very roughly what a displaced moving average would look like here. That's roughly what the displaced moving average would be. And the channel, of course, would be equal distance up above, and it would be an equal distance down below, like that. So that would be our channel. Okay, well, that's a really bad drawing, but you get the idea. There's the channel line above the centered moving average, or a displaced moving average, and there's a line below it. Now, these mid-channel pauses, in most of the charts that I've looked at, don't actually happen in the middle of channel. You would expect them to happen right at that centered moving average. That really troubled me for a while when I was trying to understand mid-channel pauses. And I would humbly suggest that the term mid-channel pause is maybe not a very accurate term, because the pause doesn't really happen in the middle of the channel. But it does happen, as Alain suggests, in the middle of the trend. It happens in the middle of that move up. Of course, where it happens in the channel is very much dependent upon the amplitude of each one of those cycles. And perhaps if we were working with correct proportionality here, in other words, correct amplitude for those cycles, then perhaps it would find itself in the middle of the channel. But to be honest, I found the term mid-channel a little bit of a distraction, because I'm focusing in those days very much on channels. I don't do a lot of work with channels at the moment, but I focused on trying to identify these things in the middle of the channel. And I found it quite difficult because often they didn't occur in the middle of the channel. So I would quite like to suggest that that you don't worry too much about it being in the middle of any channel in particular. You don't have to draw the channel in order to identify them. But they are very useful things to identify. And I'm going to show you in a moment why they are so useful. Let me just see if I've missed anything there. Something from Miguel. Be interesting to see what composite line would result from giving Fibber weights to each wave. Yes, in terms of the amplitude. In fact, with the spreadsheet, I could probably fiddle around and do that, Miguel, because I can on the spreadsheet adjust the, just the amplitude of each wave, and it is interesting. I won't get distracted with it here because it's probably going to take me a while to get it all figured out. But what does happen is, as the amplitudes of the different cycles are increased and decreased, what tends to happen is that, of course, the shape gets distorted. And in particular, this mid-channel pause, tends to move up and down quite a bit, depending on the amplitude of the two shorter cycles. It might occur lower or it might occur higher in the move, and it doesn't really occur midway in the move. Okay, so that's the sort of theory about why a mid-channel pause occurs, and Hurst described it in his cycles course. I read it, I thought this interesting, and I forgot about it, and I never really thought about it again. As you know, I'm very interested in the FLD, and I work with the FLD trading strategy, both on an end-of-day and an intraday basis, and I find the interaction between price and FLDs very interesting. And I rediscovered the mid-channel pause, if you like, by looking at the FLD and the way in which price interacts with the FLD. And I discovered a very important and useful thing to know about mid-channel pause. That is that if you can identify a mid-channel pause as it's about to happen, then you can catch an extremely profitable trade. And that is this trade here, for the price move bouncing out of the mid-channel pause. Now, we might get to speaking about price bouncing down below the mid-channel pause, but it's a slightly more complicated situation because of the fact that we generally analyze markets on the basis of their troughs being synchronized. And so moves up in a Hurst cycles analysis are always much easier to trade. I'm going to keep looking at this idealized graphic of price movement as a result of combining cycles. And let's just speak about what trades we have available to us as Hurst cycle traders. Let's just speak for the moment, first of all, about long trades. Within this red cycle, there are three really good long trades that could be made. The first long trade is, of course, this one here, as price bounces out of this trough over here of the red cycle. Now, if you have much experience with trading Hurst cycles, you probably know that catching that trade can be quite tricky. Because when a trough of a long cycle forms in the market, you are full of indecision generally. It's just the sort of strange paradox of being a cycle trader, that the best move is the one that happens when the price bounces out of a trough, but you are the most full of analysis, anxiety, and indecision when that trough is forming. So this first trade over here is often a very difficult trade to get into, because you start seeing the price bounce up and you're asking yourself, is that really the trough or isn't it? I don't know. So you wait, and you maybe eventually get into the move somewhere over here, by which time probably about half of that move is already over. If you have traded using Hurst cycles, you'll know that that is a reality of trading with Hurst cycles, that you really have to have nerves of steel to correctly identify the big troughs at the time that they happen. The next long trade that you can make within the red wave, if you like, from the left of this graphic to the right hand edge of the graph, the next long trade is this one over here. Now, this is the trade that you take after price breaks out of this mid-channel pause. And that is a great trade. I enjoy trading that particular move. And I believe that I have personally made more profit trading that move than I have ever made from trading this first move over here. The reason for that is that uh, when you can begin to start identifying the mid-channel pause, your confidence in the analysis shoots up very quickly. There are some really telltale signs that you can recognize in the market. When you see those things happening, everything falls into place and it just looks perfect. And the other useful thing is that you can usually get a very tight entry. Not only a very tight entry, but you can set a very tight stop loss in case you are wrong. And those two things combined make this a really great trade. And so you can capture a good deal more of this move than you often do capture out of first move. So it's a really useful trade. In my opinion, it's perhaps the best of all of the trades. The next long trade that, of course, you can make in the full wave of the red cycle is this trade over here. And that is also a good trade. In my opinion, it's not quite as good as the trade that breaks out of the mid-channel pause because you don't have as many telltale signs. And I'm going to look at those telltale signs in a moment, and you'll see what I'm talking about. You don't have as many telltale signs for that third long trade, and so you tend to have higher anxiety surrounding that trade as well. Now, just quickly before I move on and look at the actual market, you will recognize in this chart, if you are familiar with the FLD trading strategy, which is a strategy that I trade and that has proved to be very popular, you'll recognize the trades that we take in the FLD trading strategy. And they are these trades over here. And if I draw a rough representation of the FLD, this is a very rough representation of the FLD, and there it is there. And so here is our A category FLD trading strategy trade, which is a very good trade to make, but it is often a trade riddled with anxiety because you don't know for certain that that trough is formed. This trade that I'm speaking about now, the break out of the mid-channel pause, is the C category trade. Okay, the B category trade is this move down, which we don't take. And then the E category trade is this one over here. And you know that those are really your three long trading opportunities in any cycle. And the C category trade is a category of trade that is generally very reliable and is often very profitable. The reason is because you normally get in very tight, a very tight entry and a very small stop loss. So you're not carrying a lot of risk and you can make a lot of profit out of it. So that's how it relates to the FLD trading strategy. Let's take a look at the real market, and let's for a moment, what am I looking at here? I'm on the wrong chart. I wanted to take a look at the euro to US. And I'm going to show you an example of a mid-channel pause that has recently occurred in the euro to US dollar. And I'm going to show you how you can begin to recognize the formation of the mid-channel pause and how you can make the trade as price bounces out of that mid-channel pause. It's a really very useful technique, and you can apply it at many different levels, from end of day all the way down to intraday. You can work with it intraday. If we have time, I might even quickly load up an intraday chart and just show you how you can work with it intraday. First of all, let's quickly have a look at the euro to US dollar. Let's just zoom all the way out, and let me show you. In previous webinars, so I don't think I should really dwell on it very much, but the important thing is that I believe that there was a very trough, a 54 trough in March of last year. Okay, 54 months is 4.5 years. And so if we zoom in and have a look at what has happened since then, you can see how price bounced out of that 54-month cycle trough in March of last year. Made a very nice M shape over there. Can you see that M shape? Perfect M shape, and then formed a 40-week cycle trough over here in December of last year. And in fact, in our, I think it was our last webinar of last year, the last webinar in December last year, I spoke a bit about the euro dollar and mentioned that it looked as though the 40-week cycle, the 40-week cycle trough had formed in the markets. Okay, so that sort of brings you up to date with the analysis. Let's just zoom in a little bit and see what has happened since that 40-week cycle trough. So here is the strong move that carried price out of the 40-week cycle trough. There it is in the first week of December. Now, let's start looking at this in terms of a mid-channel pause. What's the first thing that you look for finding a mid-channel pause? Well, let me just go back quickly to a chart and point out that the first thing you need is a big trough. Okay, then the mid-channel pause is going to happen at the trough, which is 2 degrees shorter. In other words, 2 cycles shorter. So in our graphic, our longest cycle that has just formed a trough is the red cycle. The next shorter cycle is the blue cycle, and 2 cycles shorter is the orange cycle. So you can see that at the first trough of that orange cycle, that time-wise is when the mid-channel pause forms, is at the first trough of that orange cycle. I see Vitaly's jumping in with a question about intraday trading. Yes, Vitaly, we are planning a webinar about intraday trading with Sentient Trader. The reason, as a matter of interest, that we haven't done it yet is because you might know we've been working on trading platform plugins which sit on your trading platform and interact with Sentient Trader and work on your trading platform. And I made the decision a while ago that I would do the intraday trading webinar once we had the trading platform plugin working. It is actually working now, and so we're getting that intraday trading webinar soon. In fact, I might, if I have time in today's webinar, I might quickly pull up MetaTrader 4 trading platform and show you that, and we'll see if we can identify some mid-channel pauses intraday. Let's see if I can do that, if I can squeeze. Let's quickly keep going with this discussion. So as mentioned, when identifying the mid-channel pause, first of all, we need a big trough. Here we've got a big trough for the 40-week cycle. Then we're looking two shorter. From the 40-week cycle, 1 cycle shorter is 20 weeks, and 2 cycles shorter is 80 days. So round about the time of the 80-day cycle trough, which is round about here, here's the nest of lows. For those of you who are not familiar with the nest of lows, that tells us when we are expecting the next trough of that particular cycle. Which cycle, you might ask? Well, it's the longest cycle in the nest of lows, which is this cyan-colored cycle over here, and that is the 80-day cycle. And so following the formation of the 40-week cycle trough over here, we might expect a mid-channel pause to form round about the time that we expect the 80-day cycle trough to occur. So let me clear this drawing. Here is a very nice, neat nest of lows telling us when we expect the 80-day cycle trough. So as the market moves towards the 80-day cycle trough, we might expect a mid-channel pause to form. Now, there's a very important point to make. The market does not make mid-channel pauses every single time it forms a trough in the markets. Mid-channel pauses, I wouldn't say they are rare, but they certainly do not occur every single cycle. In my experience, if I was to guess, I would say mid-channel pauses form about once out of every 5 cycles, roughly. And the conditions have to be right for the mid-channel pause to form. Now, what conditions need to be right? Well, what needs to be right is the amplitude of the various cycles involved in forming pause. In this particular case, you need a good, fairly strong amplitude for the 40-week cycle, and you need strong and closely related or harmonically related amplitudes for the 20-week and the 80-day. But let's not worry too much now about when they do form and when they don't form. The important thing is that after the formation of any cycle trough, when the cycle shorter than that is due to form a trough, you should start looking out for the formation of a mid-channel pause. Because if you can see a mid-channel pause forming, then you know that you can make a profitable trade. And the fact that it is a mid-channel pause, or as Alain pointed out, perhaps more accurately called a mid-trend pause, means that you know roughly how much profit you can make out of it. And what you do to work out how much profit is you measure the move that happened before the mid-channel pause. Okay, so let's speak about how I was sitting here watching this mid-channel pause form and how you can start identifying mid-channel pauses in the future. Right, the first thing, of course, to be aware of is that you are looking for the trough 2 degrees shorter, or even shorter, but I'll go into that a bit later if I have time. But certainly, we're not waiting for the 20-week cycle trough. So we're looking for 2 cycles shorter. That's this 80-day cycle trough over here. When we're expecting the 80-day cycle trough, we have a look at the market, and we ask ourselves in very simple terms: have we seen a move up followed by a sideways move? Because that's what a mid-channel pause is, right? I mean, if we go back to this graphic, I called it a wobble earlier. You see a move up, and then you see a sideways movement. It's a pause in price movement. It's what the people who know what they're talking about call consolidations. It's a period of consolidation. That's the official term of it. And so you have a look at the market. Ask yourself, am I seeing a consolidation? In particular, look for some classic technical analysis patterns. And the favorite one for me is a contracting triangle. Can you see that trend line that I've drawn there? And you can draw a trend line. That is a contracting triangle. It's really easy to recognize. So as we were approaching the time at which we expected this 80-day cycle trough to form, you have to say to yourself, am I seeing some form of consolidation in the market? Now, we normally expect cycles to create M shapes in the market. There's a perfectly balanced M shape. Now, that M shape can get distorted, and sometimes you get an M shape that looks like that. Can you see the contracting triangle there? Okay. When you see your M shape getting compressed like that, and the market seems to be trapped in a band or between 2 trend lines, that is a sure sign that the market is ripe to form a mid-channel pause. So let's have a look. Let me just clear that. Let's have a look at the M shape here for this 80-day cycle. I'm always drawing M shapes. I find it really very useful. So you go up to the first peak, then you come down to the trough of the 40-day cycle, then you go up to the next peak. Okay, and then then you're coming down again. And so perhaps a week before this mid-channel pause was broken out of, about a week before that, we were looking at a shape that was definitely compressing. Can you see how it looks like a kind of, one of those sort of cartoon spirals they draw by people's heads? It gets smaller and smaller. So that's a typical sign of a mid-channel pause that is forming in the market. When you see that happen, you should stand by. Why? Because when the market breaks out of the mid-channel pause, you have a fantastic opportunity, which is very often the same length as the move into that first peak. So you can expect the same magnitude move up again, and it's going to happen as price breaks out of that triangle. Now, if you're familiar with classical technical analysis, then you will know that the measurement for a breakout from a contracting triangle is measured in the same way. Okay, so all of these things make sense. Okay, they're all just different ways of saying the same thing, I find very often. Okay, so is that the only way that you can recognize a mid-channel pause? So far I've pointed out two things. First of all, you're expecting a trough of a cycle which is 2 degrees shorter than the cycle that formed the big trough that you can see on the left of the chart. That's the first thing. The second thing is you're looking for some kind of pause in price move or some kind of consolidation, particularly a triangle, which is very evident there. That's the second thing. Are there any other signs that a mid-channel pause is potentially forming and you should stand by? Yes, there are. There is a wonderful and very clear way of recognizing that a mid-channel pause is forming, and that is the FLD. Okay, so here is the FLD for the 80-day cycle. Okay, first of all, which FLD should you look at? The FLD you should look at is the FLD for the cycle 2 degrees shorter. In other words, in this example, our 80-day cycle. You must look at that 80-day FLD. What happens when a mid-channel pause forms? And this is not something that Hurst stated, it's something that I've observed. And it happens time and time again, and we'll start seeing this in your charts and hopefully start trading it. What happens when a mid-channel pause is forming is that the 80-day FLD, and I'm just going to draw over, I'm not managing to draw very clearly. I'm going to draw over it because I know it's probably not very clear on your screens. There we go. I'm drawing over that 80-day FLD there. The 80-day FLD provides resistance at the level of the mid-channel pause, or at the time that the mid-channel pause is forming. It's a really important point, and when you see it happening, it is wonderful because you know that you are getting confirmation that the mid-channel pause is forming. Let me just zoom in here, and we can look at how accurately this works. Can you see how I can sort of pause that? No, I can't pause that. Can you see how price came down here and met the 80-day FLD and bounced straight up with it? Can you see how accurately it did that? The FLD provided resistance. The moment you see an FLD providing resistance, start looking around and see if it is part of a mid-channel pause. Okay, then price dropped a bit below the FLD, bounced back up to it, okay, and down, sort of kept tracking along it. I call that tracking along it. Okay, when price keeps coming back to the FLD and keeps straddling it with the high above the FLD and the low below the FLD, you will see this time and time again at the formation of a mid-channel pause. When you see it, it is warning. And here we had a month's warning. In fact, I first noticed it. I was taking a holiday, and I first was looking at it. I was in the Middle East, and I looked at the chart of the euro US dollar, and I could see price coming down and finding support at the 80-day FLD. I knew then, look out for your mid-channel pause. Then look what happens. Price comes up, it drops below the FLD, comes up to the FLD, can't get above, drops down again, and we're expecting the 80-day trough over here. Okay, and a week before we were expecting that 80-day trough, suddenly price breaks up strongly. That is your break out of your mid-channel pause. That is your trade. It is, in my opinion, one of the best trades you can make using Hurst cycles. It's the most consistently profitable trade, I believe, I take. Okay, so how do you stand by to make this trade? Fortunately, the channel pause is also a fairly easy trade to make, because generally, let me just turn that FLD off. Generally, have a VTL. Let me see if I can just draw that VTL. There we go. Generally, you have a VTL, or if it's not a VTL, it will be just a normal trend line. A VTL is a valid trend line. And that valid trend line generally gives you a very good entry. I think you can see that. At this point, that was the entry into this long trade. If you're using VTL, you might use any manner of other things to recognize that breakout. Now, you could also have used the high of a few bars before, or something like that, to validate the breakout. But the important thing is, when a mid-channel pause forms, you don't expect price to come down and form, a proper 80-day cycle trough, because the mid-channel pause is forming, and in a mid-channel pause, price doesn't come down. Okay, if we go back to our graphic for a moment, you can see here, you can see price doesn't come down to form this orange cycle trough. It stays up there. Okay, it sort of stays hovering around there. So how do I clear that? There we go. So you're not expecting price to come down. Why not? Because of course it's being supported. It's finding support at the level of the FLD. Now, when should you expect price to break out of your mid-channel pause? This is a very important point. Price will break out of a mid-channel pause prematurely. It will happen early, and it almost always does. Why is that? I see Will Jones saying, "What's up?" Perhaps Will's just joined us. Hopefully he hasn't got lost in what I'm saying. Okay. When does the mid-channel pause form? Now, unfortunately I can't sort of draw vertical lines here, but if I draw a vertical line up from this orange cycle trough, that's about as vertical as I. Do you notice that the trough in price, the trough in the green line, is to the left, or happens before the trough in the orange line? So the trough in the orange line is where the cycle itself forming the trough. However, the trough in price happens early. Okay, so if I connect the orange line trough with the green trough, the price trough, you can see it leans over to the left a little bit. On the way down, as a matter of interest, it leans over to the right a little bit. Okay, so that is called left translated over here on the left side, and right translated on the right side. What it effectively means is that price in trough is expected, the trough in price, I beg your pardon, the trough in price is expected to occur earlier than the actual trough in the cycle itself. So let's go and have a look here at price, and you see the nest of lows tells us when we're expecting the trough in the cycle. It was over here. It was pretty much over the weekend that's just passed. And when was the trough in price? It was before that. Okay, so that's a very important point about mid-channel pauses and trading them, that you should expect that trough in price to occur earlier than you are expecting the trough. So you need to stand by. Luckily, you generally get a lot of warning, because you can see that contracting triangle forming. Okay, so that's a mid-channel pause in price. It's such a textbook example that I thought I really needed to speak about it in this webinar. I posted a blog about it over the weekend on Friday. The mid-channel pause is a really very, very useful useful pattern to trade. And what I will try and do, I've promised I'll try and pull up intraday chart, and I'll show you how mid-channel pauses form all the time in intraday charts, and they're very useful, very powerful patterns to trade on intraday charts. So I will do that. Before I get there, I want to, if you have any questions about the mid-channel pulls, please go ahead and ask them. But what I did want to show you, very importantly in my opinion, is this very long-term analysis of the S&P 500. So this is the S&P 500. Let me go all the way back. This is S&P 500, of course, the US market. This chart goes all the way back to 1950. Okay, so I've got data going all the way back to 1950, and I performed a Hurst cycles analysis on that data. And here we can see the results of that analysis displayed, of course, at the foot of the chart. And so you over here, what is that, 1974, I believe. That's a really big, important trough forming over there. And so we can have a look at a bit more detail if we zoom in. I see a question from Najmuddin. I hope I'm pronouncing that correctly. How does Sentient Trader differentiate between cycle lows and price lows? The diamonds below signify which of the two? The diamonds signify the manifestation of the cycle low in price. So in answer to your question, the diamonds mark the lows in price. There's a fascinating debate that you can have, the relationship between cycle troughs and peaks in price related to the actual troughs and peaks in the actual cycles. Personally, of course, I'm interested in identifying the troughs and peaks in price and not actually the troughs and peaks in the cycles, because it's interesting to know where the cycles are forming their troughs and peaks. What I want to know is where they're forming in price, because I'm trading price. So Sentient Trader focuses on price. Most of the time, to be honest, you can pretty much not ignore it, but what tends to happen is that a perfect cycle picture will look perfect generally. Of course, you get variation in cycle and so on, but just the cycle picture will look more perfect. Price picture looks more messy. You get more variation in cycle wavelength. That's because even if the cycle itself isn't stretching or compressing quite as much as it looks like it is in price, it's because the troughs and peaks are displaced in price. Okay, so I see Will saying, where do you have the most recent 9-year cycle trough? Okay, so let's speak about this. I'm sharing this analysis with you, not because I think this is definitely the correct analysis and this is what is happening, but for a while I've been watching this analysis, and I want to show it to you, sort of bounce it off you, and see what you think. And let's talk about it. So I've zoomed all the way in here, and you can see that sort of the really important thing that's worth mentioning right off the bat is this trough in March of 2009 is labeled as a trough of the 18-year cycle according to this analysis. 18 years. That's a really long cycle. Now, before you sort of jump in there and say, no, 2009 could not have been the 18-year cycle trough, I'd like to demonstrate something about the mid-channel pause that gives me reason to suspect that the 18-year cycle trough might have occurred in 2009. Let me just clear that and let me turn off the semicircles. There we go. Okay, so, and let me just go back to a weekly chart, I think. There we go. Now, I have mentioned, I've been speaking about the mid-channel pause, and I've mentioned that, of course, the first thing that you need to do is you identify a really big trough. So here's a really big trough over here in March of 2009. then what you do is you step down 2 cycles. So let's just go with this reasoning for a moment. Let's assume that the trough in 2009 was an 18-year cycle trough. Step down 2 cycles, 9 years, and then 54 months. Okay, that's the nominal model that we work with. So the 54-month cycle. Where is the 54-month cycle? Let's actually just zoom in and see if we can get a slightly better look at this. Here we go. Where is the 54-month cycle? Well, of course, let's not focus on the phasing for now. Let's measure it. Where would we expect a 54-month cycle to occur? Let me measure 54 months. There it is, 54 months. The 54-month cycle would have to occur in about the middle of 2013. Can you see that? That's 54 months there. So in about the middle of 2013, we would have expected the 54th cycle to form. Now, of course, we expect 3 18-month cycles. So here is apparently the first very nice bullish shaped cycle. Here's the next 18-month cycle, a less bullish cycle. Can you see that? So that's interesting. William says, according to a spectral approach, the longest wave in the market occurred in 2009. So that would be, I think, in support of this argument. Okay, so we've got 2 8-month cycles that I've drawn there. This one here is really, very bullish. Let me see if I can write the word bullish. Probably not. This pen isn't very good. No, bull. I'll say bull. And then this here is more of a neutral shape cycle. Can you see that? It's still bullish. It ended slightly higher than it started. It has a slightly later peak than halfway, but I would call it neutral. And then, of course, we would expect a bearish 18-month cycle to form after that. Isn't that true? That's the normal sequence. Within a 54-month cycle, you get a bullish, then a neutral, then a bearish 18-month cycle. But what actually happened? Well, as you can see, our next 18-month cycle turned out to be a bullish cycle. Now, as that started happening, I started wondering what was going on over here. Let me draw some other lines. Can you see this formation over here? That's what I believe the experts call a rising wedge. It's effectively it's a consolidation pattern. It's similar to a contracting triangle, except that both lines are moving up instead of the top line moving down. It has very similar implications. When you start seeing a pattern like that, in my opinion, you need to start wondering whether what's happening is a mid-channel pause. So let's just sort of go through that again. We were expecting a trough of the 54-month cycle, which is 2 cycles shorter than the 18-year cycle. We were expecting it about here in the middle of 2013. But we started seeing evidence of a kind of not necessarily a sideways movement in the market, but a sort of a consolidation with that rising wedge that's happening over there. The next key that we have to identifying a mid-channel pause is to see where the price found support at level of the FLD. So let's turn on the FLD for the 54-month cycle, and there it is. Now, isn't that interesting? I'm going to zoom in a little bit. Can you see how over here the 54-month FLD provided perfect support just for one week or less than a week? Price dropped below it. Then over here again, the FLD was below price. Price couldn't even get down to it. Okay, when you see that happening, of course, it's an indication that potentially a mid-channel pause is occurring. All the signs are there that what we are seeing here is indeed a mid-channel pause. So let me just zoom out and just go through that again. If we assume that this trough in 2009 is a trough of the 18-year cycle, then we might expect to see a mid-channel pause forming at the first 54-month cycle, and here it is over here. we have a consolidation pattern, we have price finding support at the level of the FLD, and what's the final indicator or sign that this is indeed a mid-channel pause? We expect to see the trough happening earlier in price than it does in the cycle. Again, is that what happened over here? Yes, indeed, because we expected the 54-month cycle trough to occur in the middle of 2013, whereas it in fact occurred, according to this analysis, in November of 2012. So it occurred 9 or 10 months early. So this particular formation ticks all the boxes, in my opinion. It ticks all the boxes for this being a mid-channel pause. And I'm not the first person to think of this. In fact, it was mentioned by one of our Intraday users who mentioned it on in response to a blog post, suggesting that there was a mid-channel pause forming at the level of this 54-month cycle. So I can't take credit for this. But what does that mean? If this is indeed a mid-channel pause that we're seeing, a really long-term mid-channel pause, what does it mean? Well, what it is that the trough in 2009 probably was a trough of the 18-year cycle. Okay, then what happens is we get a move up, then we get the mid-channel pause, which is the wobble, then we get the move up to the first peak. Then price comes down to the intermediate peak, which is, of course, the 9-year cycle. And I don't know if you can see this nest of lows, but it's over there. So we expect the 9-year cycle trough to happen fairly soon. And if you watched a previous webinar with John, you'll know there's the possibility that trough might be coming really very soon. And so price will move down to there. Then it'll bounce up to form the second part of the M shape. Then it will come down, and then it will form another wobble, and then it will come down again. Now, Alain mentioned earlier that we were looking at an idealized graph that had no underlying trend. And that is because channel pauses are most obvious when you look at a chart that has little or no underlying trend. The fact that this potential consolidation pattern over here for our mid-channel pause is a rising consolidation pattern. You can see price rose in the course of that consolidation. Indicates that probably the underlying trend is slightly upwards. And so let me redraw this chart using the information we have at our disposal. There's the move up, there's the mid-channel pause, there's the first. We're going to get a move down into the 9-year cycle trough. Then you would expect to move up to a higher peak, probably, and I'm drawing off the chart there, and then you'll come down, get a mid-channel pause, and you'll come down. And this big move into the next 18-year cycle trough is likely to be a very dramatic and strong move down. But if this underlying trend remains positive, is unlikely to take us down below the levels of 2009. So that really concludes what I wanted to speak about in terms of the mid-channel pause. I think it gives some very interesting insight for the long-term analysis of what's happening in the US markets. And it really sort of supports the argument that the 18-year cycle trough formed in 2009. If we zoom out on this chart, I think there we go. And of course, I'm using logarithmic scaling here, so you can see. And let me just pop up the semicircles. I think you can see the implications of this. Here we had a nice M shape. That's the nice M we had for the previous 18. And so what I'm saying is that the M shape for the next 18-year cycle is going to be something like that. And of course, that takes us all the way up to 2027, where that next trough is happening. So this is not really a sort of a short-term analysis. Okay, Will, is it possible to pull up a long-term, oil long-term chart? Let me see. I have an oil chart. I'm afraid I don't think it's long term, but what I can do is load up the data. Here's crude oil. I don't think I have much data here. Let's just see. It's back to 1988. It's not too bad. Right. And so in terms of this discussion, what was the magnitude of that 2009 trough? I'm really just rather speaking off the top of my head here, but it's quite possible that the 18-year cycle trough formed in stock markets. However, it was only a 9-year cycle trough in terms of crude oil. Possibly, I don't know, or maybe it was also an 18-year cycle trough. Or, of course, bear in mind the comments from John's webinar not last week, 2 weeks ago, where he mentioned a 14-year cycle in crude oil. Okay, so I'm afraid I don't really have sort of much to say about oil. I need to look at it. Perhaps I should load up more data. I'll try and make that a task for our next webinar, and then we can have a look at that. Steve says, "Can we have a look at the strong move in gold?" We can have a look at it. Just check if I've updated data. Only issue. What I would like to quickly do is show you a mid-channel pause. Here we go. Is show you a mid-channel pause in intraday. So I know there've been lots of requests for that. Here we go. Again, Steve, I'm afraid I haven't actually sort of prepared a discussion of gold, but there's that big move up in gold, and it looks as though that 18-month cycle trough, according to this analysis, might have in December. I hope you were all watching the webinar that I did with John in was it or October? It was a webinar in October where John stand by for a turnaround in gold. Here we go. I'm just sort of flicking through chart. I don't think this is really going to be very to you. There is something I would like to point out about gold, and you can see it quite clearly here. Hurst's cycles, as you know, are on the basis of troughs being synchronized, and troughs work very well synchronized in stock markets. In gold, I believe, because it's a precious metal, because it's effectively a commodity, I believe that you have peaks in gold. So you get very sharp peaks. Look at these sharp peaks. The peaks are all very sharp, and the troughs all tend to be very rounded. Can you see that? I think this chart of gold gives a very good demonstration of that. And so I personally, in terms of the peaks, and so so we can start having a look at the peak analysis here. There was one there, and clearly prices coming up and expected to form a 20-week cycle peak fairly soon. That looks pretty imminent. Rajiv, the gold index chart. I regret I didn't update the GDX data. I do apologize for that. I will update that data for 2 weeks' time. We can have a look at what data I do have. Where is it? GDX. Yeah, I'm afraid this only goes up to December. Sorry about that, but for next week's webinar, I'll make sure I update all of this data. I was expecting just to spend the whole webinar speaking about the mid-channel pause. Perhaps if you would be interested, I will quickly show you how I work with the mid-channel pause on an intraday chart. Steve, can I zoom out? Yes. What chart are you looking at, Steve? There we go. Okay, the composite line looks like it's presenting more data. There we go. So that's the gold index, the gold miners index, I should say. Wants to see the 52-week cycle. Okay, let's see. Here we go. I think this is perhaps the chart you're looking at. And let's go daily, and let's go semicircles. There we go. So that's the 52 week, 52. That's the 52-month cycle, particular analysis in gold. But as I said, I haven't really sort of prepared these charts and studied them and looked at them and so on. 52 months. There we go. That's the 52 months. That's according to this analysis. I would encourage you, if you're interested in gold and you haven't yet seen it, take a look at John's webinar about gold. If you have a look at our Sentient Trader YouTube channel, you can find it. It was very popular. It's been viewed many times. John speaks about what he sees is the outlook for gold, and in fact, get him on the line again soon for an update in terms of what's happening in gold, so we can focus on gold. Let me just quickly show you what's happening intraday and how I like to apply the mid-channel pause intraday. And I do apologize if starting up this trading platform is going to slow down my internet. If you start having audio problems and so on, then I do apologize. What I'm going to show you, there we go, that's the sound of MetaTrader 4 starting up. And what I'm going to show you is a analysis. Let's just look at the euro to US dollar. And sorry, I'm just lining up the charts so that I have something to show. It's a bit tricky getting MetaTrader 4 to fit into that box. There we go. All right, and let's pull this in. Okay, so where should we start? Let's just start with the daily chart. I promised I would give everyone a glimpse of using this intraday. I don't have an intraday chart loaded up in Sentient Trader, but I'm working here with the trading platform plugin, the Sentient Trader or Hurst Cycles trading platform plugin, which is something we've been working very hard for an extremely long time, but it's now working, and it's working really, really nicely. It's really fantastic. I won't go into much detail about it here, but it performs a Hurst cycle analysis directly on your trading platform, directly in your trading platform. We have, as you can see, nearly completed it for MetaTrader 4, and we're also developing it for NinjaTrader, eSignal, TradeStation, Thinkorswim. We've got a whole range of these indicators coming out, and they're really fantastic. They work. They will work with Sentient Trader, so you can export your analysis from Sentient Trader and see it in MetaTrader or your trading platform. And they also work autonomously, so they will actually do their own thing. So, you to export your analysis, it will do it. Gigantus wants it. Yes, okay, good. Right. Oh, I see an interesting question from, is it Demid? So the rise of the mid-channel pause in the euro is over. Okay. Well, a complicated question. Let me just quickly go back to because it deserves a considered answer. Let me just go back here. Demid, I'm not sure how to pronounce your name. I hope that's correct. The rise out of the mid-channel pause generally is expected to be about equal to the rise into it. That's a very rough guideline. So here we had a rise. I don't know if that was about equal. It looks as though it's getting there. In terms of finding the end of that rise, that's a fairly complicated thing to do because it means you've got to find the peak, and identifying the peak can be complicated. Having said that, let's have a look at what our new Hurst Cycles plugin does on MetaTrader 4. It does a simultaneous trough and peak analysis, which of course Sentient Trader does as well. But you can see here that this peak here is rising up to the 80-day the 80-day nest of highs. So we're looking for that peak. As Sid says, thrusts from Elliott wave triangles are terminal. It's the end of the pattern. It's a very important connection, if you like, between Hurst cycles and Elliott wave. And I love the way the two of them work together. So Elliott wave defines it, of course, as a terminal move. It's the end of the move. And in terms of Hurst cycles, if that's a mid-channel pause, which I'm convinced it is, then it is also the first peak of the 40-week cycle. Then price will come down into the 20-week cycle. Then it'll come up and it'll form another peak, but that's by then we're several months away. Okay, so we'll talk about that when that happens. Right, so let me quickly show you. So this is the daily chart in MetaTrader 4 using the Hurst Cycles plugin. What I wanted to do was show you the formation of mid-channel pauses intraday. That's why I'm showing you this particular thing. Here's an hourly chart. So this is, of course, extending the analysis down to the hourly level. And here's a 15-minute chart. Let's look at the 15. Well, let's look at the hourly chart. Okay, here we go. Let's speak about mid-channel pauses intraday. And here, right, staring us in the face is a perfect example. This purple line is an FLD. So it's not quite so easy, so zooming in and out of MetaTrader 4. Okay, so let's look at our daily chart. Here is the 80-day cycle trough, all right, which formed on the 29th of January. That's the trough we've been talking about throughout today's webinar. I see Tycho saying, are we developing the in for pro real-time as well? We're not at the moment, Tycho, but send us an email about it, info or support at Sentient Trader, and put your request in. The plugin has been developed in a modular way, so it can fairly easily be adapted from one trading platform to another. And furthermore, it is accessible. It's not open source, but it's there's an API. And so developers are already getting stuck in developing add-ons on top of the Cycles plugin. And so if we don't develop the pro real-time version, then no doubt we could find a developer who will do that for you and develop the version for that trading platform. Okay, so here's our 80-day cycle trough on the 29th of January. Right, we've been speaking about that all day today. Last week, and in fact I was looking at this chart, but on a different computer. Here is the 80-day cycle trough on the 29th of January. I hope you can see this chart. I can't really sort of zoom in on it because MetaTrader 4 is a little bit clunky in terms of zooming and in and out. But there it is. That's the 80-day cycle trough. You'll notice these shorter time frame charts don't show all the cycles all the way up to. That's because of a setting that I have on this chart to limit the number of cycles that it actually shows me. And so anyway, there is the trough of the 80-day cycle. Now, as a particular cycle trough is forming in the markets, and let me just clear this and show you something else I can do here. I'm going to show you what I was looking at last week, which is this situation over here. Okay, there we go. So price was bouncing out of a trough that potentially might have been the 80-day cycle trough. We knew to stand by for that because of the mid-channel pause formation that we'd seen on the end-of-day chart. Okay, I was watching it intraday, and can you see what developed over here? Let me draw the lines. Don't all shout at once. That's a contracting triangle. Okay, that's one of the first that you know forms at the level of the mid-channel pause. Now, of course, this is at the 5-day level. Yes, and we're looking at a bounce out of an 80-day cycle trough. Yes, but you can extend this reasoning deeper and deeper and lower, so you don't have to only look for the 20-day cycle mid-channel pause. You can look for every cycle shorter as you go, and as is demonstrated over here. This purple line on the chart is the FLD for the 5-day cycle. Can you see what happened as price to the point at which we were expecting the 5-day cycle trough in price? It came down towards the FLD. It didn't even touch it. You might say it's finding support, but it didn't even touch that line. And if we measure the amount of times, and measuring time in MetaTrader 4 is not an easy thing to do, but we can roughly do it. From the 29th of January, 6 p.m. until over here, let's look at the 3rd of February at 8 a.m. That is how many days? That's 4 days and 8 hours. What's the average length of a 5-day cycle? 4.3 days, which is 4 days and 8 hours. Isn't that interesting? So it wasn't particularly early, but it was certainly on time, and we get a bounce. We get a bounce happening over there. So, example of a mid-channel pause that is happening on an intraday basis. Okay, there's your contracting triangle. Here's your FLD providing support. What you will find is on an intraday basis, you need to be a little more flexible about your rules. And often price will come near to the FLD, but it won't actually find support at the level of the FLD. It'll go slightly below it, or it'll stay up above it. Things happen a lot faster, and there's a lot more noise intraday, so you have to be more flexible. But identifying mid-channel pauses on an intraday basis is also a really fantastic way of making profitable trades. Because you see, if I just clear this over here, if I'd been watching this chart, well, I was watching it. As I was watching this chart over here, I was expecting an 80-day cycle trough to come in. I'd identified my mid-channel pause. So I was expecting it to come in early. Everything was lining up. But then you start looking at your intraday charts, and you're looking at the hourly chart, or you're looking at the 15-minute chart. You can look at the 5-minute chart. Here's the 5-minute of the euro to US dollar. You can see our intraday cycles are being identified and all everything. So as you're looking at price moving, as it starts bouncing out of the actual trough itself, you've got to be quite careful. It can be quite dangerous getting into that trade too early. What I find much more useful, it's a much safer way of doing, but it's very profitable, is you wait for the formation of a mid-channel pause. When you see that mid-channel pause, contract triangle, nice support at the level of the FLD, exactly when that trough is expected, perhaps slightly early, earlier than it was expected, then you know you have a good mid-channel pause forming, and you know that you're getting a good opportunity to make a trade for the bounce out of the mid-channel pause. Stuart, what nominal model am I using? Stuart, on the plugin, do you mean? For this plugin, I've been using Hurst's default nominal model. As a matter of interest, you can export an analysis from Sentient Trader to your trading platform plugin, and it will then work with the nominal model that you've built in Sentient Trader. The trading platform plugin doesn't have a nominal builder, because it's just a plugin. So what happens is that if you want to work with different nominal models in your trading platform plugin, then you will need to export them from Sentient Trader, and you can work with them in your trading platform plugin. Stuart, the Hurst intraday. Oh, you mean the nominal model? The nominal model intraday. Okay, that's a subject that I'm going to be recording lots of videos about and speaking about often. We'll have webinars solely dedicated to it. The nominal model, the intraday nominal model, that is being worked with in the trading platform is what I call a dynamic nominal model, and it's a nominal model I've worked with for some time. It's complex. The important thing is it's dynamic, so I can show you here very easily. You see the white cycle, that's the first intraday cycle, and you can see here between that white cycle trough and that white cycle trough, there are two purple cycles, whereas between this white cycle trough and that white cycle trough, there are three, 1, 2, 3, and between this white cycle and that white cycle, there is only one. That's what's called a dynamic dynamic nominal model, and the trading platform plugin works with a dynamic nominal. So before I confuse you all terribly, I am going to be explaining all of that in great detail. It takes the approach that the nominal model on an intraday basis is dynamic, and it changes, and it turns out to be a very, very useful approach to trading intraday. But obviously there's a lot to explain. I will be explaining all about it, so we'll be telling you all about that dynamic intraday nominal model. It's a great thing to work with. Well, I think it's time for us to call an end to this webinar. It's nearly 3:30 here, and I do hope you've found it interesting discussing the mid-channel pause, and I hope that you will quickly learn to identify mid-channel pauses for yourself and catch those really very profitable that you can make as price breaks out of the mid-channel pause. Thank you very much for joining me, and as always, I wish you profitable trading. I look forward to seeing you again in 2 weeks. There'll be a webinar next week because of other demands on my time, but in 2 weeks' time we'll be getting together for another webinar. So I look forward to seeing you then. In the meantime, I wish you profitable trading. Thank you very much for your interest in Hurst cycles, and